Hey, what is going on, guys? My name is Nick, and in today's video, I'm going to be sharing 3 very cheap Canadian stocks to potentially buy right now. In fact, all 3 of the stocks I'll be discussing in today's video have a forward price to earnings ratio below 10. That means all of these companies could technically pay for themselves within a decade using their earnings. So in a minute, I'll be answering the question whether or not these 3 TSX stocks are a great buy at the current prices right now. So make sure to drop a like on this video if you do enjoy, and don't forget to subscribe if you have not already and you enjoy this type of Canadian content. Finally, I'd like to thank today's video sponsor NEO, but more on that later. Now, the first cheap Canadian stock on my list here today is EQ Bank with ticker symbol EQB.TO on the TSX. EQ Bank is an online Canadian bank that offers high interest savings accounts, investment accounts, competitive loan rates, and much more. And since they are an online bank, this allows the business to maintain very high margins as opposed to many other Canadian banks that have branches all over the country, and therefore a lot of overhead expenses too. Taking a look at the stock, EQ Bank has done incredibly well over the past 5 years, where it's up nearly 150%, not including dividends, while Amazon stock is only up 130% over the same 5-year period. So this $2 billion Canadian bank stock is beating out the returns of huge technology companies like Amazon. That is crazy. Anyways, here's why I believe EQ Bank is still a solid stock to buy right now. First of all, EQ Bank has been able to maintain a 10-year average return on equity, or ROE, of 16.6% per year, a 10-year total shareholder return of 540%, and a 10-year EPS growth rate of 15.7% per year, which are all absolutely outstanding for a bank stock. But hold your horses, because things get even better when we look at their Q1 2022 earnings report. As of May 10th, we can see that EQ Bank reported record results once again, where their reported earnings and diluted EPS both grew 27% year over year to $88 million and $2.51 respectively. Now, I'll be honest, this is incredibly strong growth for earnings in a bank stock. For context, we can see that TD Bank, or Canada's second largest bank, only reported 4% EPS growth in the most recent quarter, so keep that in mind for a little bit later. Next, EQ Bank reported a Q1 efficiency ratio of 39.9%, which is simply their non-interest expenses as a percentage of their overall revenue. So basically, a lower efficiency ratio reflects a much more efficient cost structure and therefore higher margins. Again, we can take a look at TD Bank, which has an efficiency ratio of 53.6% in Q1, meaning that over half of their revenue is taken away by non-interest expenses. So because EQ Bank is purely an online bank, they don't have many of these overhead expenses that the traditional banks do with their branches all over the country. Finally, EQ Bank had reported return on equity of 18.3% in Q1, and this is well above their 10-year average we saw earlier of 16.6%, meaning that management is very good at deploying their capital. Alright, now that we've covered some of the financial highlights, let me show you why this stock is so undervalued. The first thing I want to point out is EQ Bank's book value per share, which actually grew 18% over the past year, reaching $57.64 per share. So why is this number so significant? Well, good bank stocks typically trade at a 1.5 times multiple to their book value, otherwise known as the price to book ratio. But in EQ Bank's case, we can see that despite the business growing their book value per share 18% over the past year, the stock price has fallen over 10%. And therefore, their price to book ratio has dropped to only 1.08 right now, and I believe that is super cheap for such a quickly growing bank stock. But let's also take a look at EQ Bank's PE ratio, which tells a very similar story. By dividing EQB's stock price of $62 per share by their trailing 12 months of EPS being $8.89, we get a trailing PE of only 7 right now. I'll be honest, guys, I have no idea why this bank stock is trading so cheaply right now, despite the fundamentals absolutely roaring. And if we compare this to TD Bank stock once again, we can see that they grew their EPS 4% in the last quarter, and it's trading for a trailing price to earnings ratio of around 12 and a price to book ratio of 1.75. So clearly we can see there's a discrepancy between these two bank stocks, and you know which one is cheaper. Now, if I also calculate EQ Bank's forward PE ratio by assuming that their Q1 2022 reported EPS of $2.51 remains constant for the rest of the year, that would give them $10.04 of EPS in 2022. Then dividing EQ Bank's stock price of $62 by $10.04, we get a forward PE ratio of 6.2. So overall, I am incredibly surprised to see this type of valuation on a quickly growing bank stock in a rising interest rate environment. So yes, I believe EQ Bank stock is a great buy at the current prices. Now, before we get into the second stock today, I want to tell you about NEO, which is the sponsor of today's video. NEO is a digital alternative to the major financial institutions in Canada, created by the founders of Skip the Dishes, offering a wide variety of financial products. In fact, one of their their products I recently got my hands on is this Neo Cashback MasterCard, which has no monthly or annual fees. With the Neo Cashback MasterCard, you can get an average of 5% cashback at over 7,000 Neo partner locations across Canada, like Walmart, Earls, Canadian Tire, and Petro-Canada, just to name a few. But even if you decide you don't want to shop at any of their partner stores, you can still use this credit card to get 1% cashback guaranteed on any purchase. The sign-up process was super simple. I signed up online within minutes, got my digital card right away, and then I got my physical card in the mail within 2 weeks. And this card is available to anyone in Canada, even including those in Quebec. So when you sign up for the Neo Cashback MasterCard in the link below, you'll get a $50 credit, as well as up to 15% cashback on your first purchase. Guys, this is honestly a great way to both build your credit score as well as earn some cashback on the side, so I would highly recommend signing up below. But anyways, thanks again to Neo for being today's sponsor, and let's get back to the second stock in today's list, and that would be Manulife Financial with ticker symbol MFC.TO. Now, I'm sure most of you have heard of Manulife before, seen as they are the biggest insurance company in Canada, but they also offer several different financial products and services like bank accounts, investment management, and so much more. As we can see, MFC stock really hasn't had great performance over the past decade, ever since the massive crash it saw in the 2008 recession, and it still hasn't even recovered. Moreover, the past 5 years have shown absolutely no growth, with MFC being down 2%. However, with MFC stock trading down 17% from its high last year and an extremely low valuation, could this be a really good buy-in point? Well, let's find out. Starting with their Q1 2022 earnings results, we can see their net income grew to $3 billion in the quarter, up $2.2 billion from the same quarter a year ago. But since net income for insurance companies is so volatile, the better metric to look at for Manulife is their non-GAAP core earnings, which focuses on the core underlying business. So in Q1 2022, MFC produced core earnings of $1.6 billion, which was down 4% year over year. And although Manulife produced EPS of $1.50 this past quarter, up nearly 300% year over year, their diluted core EPS was 77 cents, down 6% from 82 cents per share. We can also see that Manulife's core ROE is 11.8%, being down from 13.7% last year. Finally, Manulife's efficiency ratio also increased from 48.5% to 50% in this past quarter. And remember, a lower efficiency ratio is better, so this actually means that Manulife's costs grew as a percentage of their revenue year over year. Alright, so now let's check out their valuation to see if Manulife stock is truly a buy right now. With the current stock price being $23.16 and their book value per share being $26.33, that gives Manulife a price to book ratio of 0.88, and this is unarguably cheap. Now, in terms of Manulife's PE ratio based on their core EPS of 77 cents in Q1 2022, we can annualize this to estimate $3.08 of core EPS for 2022. Then dividing their stock price of $23 by $3.08 of EPS, this gives us a forward 2022 PE ratio of 7.5. Now, I can totally understand that many people might find this company extremely undervalued and cheap at the current prices, and the fact that insurance companies should benefit from rising interest rates. But personally, I would not want to buy Manulife because of their proven track record of lackluster performance over the past decade and longer. In fact, the only reason I would consider buying Manulife stock is for their dividend, because it is quite juicy. They recently announced a dividend per share of 33 cents, and that gives them an annual dividend of $1.32, which means that they do have a forward dividend yield of 5.7%. And since they are targeting a dividend payout ratio range of 35 to 45%, I would assume this is quite a stable dividend and should not be cut anytime soon. But when comparing Manulife side by side with EQ Bank stock, there's no question in my mind that I would rather buy EQ Bank stock based on their trailing 10 years of performance. Finally, the third cheap Canadian stock on the list here today is GoEasy with ticker symbol GSY.TO. GoEasy provides loans up to $75,000 to subprime borrowers, and they are the largest non-prime lender across Canada with over 400 locations. Now, the company has two main segments, those being Easy Financial and Easy Home. Easy Financial provides secured and unsecured personal loans as well as secured savings loans, where people will get an instant decision and funding within 48 hours most times. On the other hand, Easy Home provides loans for furniture, appliances, electronics, and computers, all of which are necessary for most homeowners and are very expensive. And here we can see GoEasy stock has done quite well over history, with their stock absolutely exploding during COVID to over $200 per share. But ever since late 2021, it's been on a continual downtrend, having been cut in half nowadays, where it trades just above $100 per share. So now let's take a look at their Q1 2022 results to see if this sell-off is deserved. Right off the bat, we can see GoEasy saw massive growth in the quarter where their loan originations, loan growth, and loan portfolio all grew massively year over year, with 69% growth being the lowest figure. Management said during the quarter, the company experienced improved demand and an increase in loan originations across all products and channels, leading to a record level of first quarter loan growth and second largest quarter of organic growth in the company's history. In terms of the overall numbers for both Easy Financial and Easy Home, they saw total same-store revenue growth of 14.1% year over year, while we can see on their income statement that their total revenue increased to $232 million, up 36% year over year from $170 million in Q1 2021. They also reported a tangible return on common equity of 36.5%, which is incredibly high, and this was up from 30.8% in Q1 2021. But as we can see, their diluted EPS was down massively from last year to $1.55 due to one-time charges boosting net income in Q1 2021, while they also had an after-tax unrealized loss on investments this past quarter. So to be able to calculate their forward PE ratio, we need to see what analysts are projecting for the year of 2022, and that ends up being $11.79 of EPS. Then we can divide this number by their stock price, which gives us a forward PE of only 9.5 right now for GoEasy stock. And in my opinion, this is a very cheap forward PE ratio based on the company's growth rates. However, if you do plan on buying GoEasy stock, one thing to consider is the higher risk of defaults on their loans if we do enter a recession very soon. For example, we can see here in Easy Financial's results that the weighted average interest rate on consumer loans was 32.7% in the quarter. So with their average loan rate being this high for the biggest part of their business, GoEasy stock does see a little bit of risk that consumers could not pay this off. But we also have to consider the fact that this is GoEasy's 48th consecutive quarter of same-store revenue growth and their 83rd consecutive quarter of positive net income, so this also should say something about the stability of this business. Overall, I would say that GoEasy stock is a pretty good buy at the current levels, but you do have to keep in mind that risk of the loan defaults if we do enter a recession, so I would not load the boat currently. Anyways, the three super cheap stocks that we discussed today are EQ Bank, Manulife Financial, and GoEasy, where I would only consider buying EQ Bank and GoEasy stocks. But I would love to hear down below how you would rank these stocks in order of the best one to buy versus the worst one to buy. Just let me know down below and put a number 1, number 2, and number 3. Anyways, if you did enjoy, make sure to drop a like on this video to help support the channel, and if you haven't already, please consider subscribing, and don't forget to sign up for NEO using that link below. And with that being said, I will see you guys in the next one.